Today we are going to talk about the basic elements of a tax, the tax base and the tax rate. Imagine you have earned income from multiple sources. Now you wonder how the tax burden on your income is determined. On an abstract level, the income tax burdens of individuals and corporations are determined similarly. First, you have to determine the tax base, which refers to the income derived from taxable factors such as labor and capital. Income from labor includes wages, salaries and benefits in kind, while income from capital consists of business profits, rental income and capital income, such as dividends, interest, or capital gains. The tax due is determined either on a net or gross basis. Labor income is typically calculated on a net basis, allowing for the deduction of expenses incurred in earning the income. Taxes on capital income also generally follow a net basis approach. A gross tax is rather exceptional, but often applies to withholding taxes. Under a gross basis approach, no deductions from the tax base are allowed. Once the tax base is determined, the tax rate can be applied. We distinguish between two types of tax rates, proportional and progressive tax rates. A proportional tax rate remains constant regardless of the tax base, while a progressive rate increases with the amount of taxable income. Progressive tax rates may be structured as a flat rate applicable after a tax-free amount or in brackets, with each bracket associated with a different tax rate. As taxpayers earn more income, they move into higher tax brackets and pay a higher percentage of their income in taxes. Now, let's differentiate between four important tax rate concepts: statutory, average, marginal, and effective tax rates. The statutory tax rate is the rate defined by tax law. The average tax rate refers to the average tax burden on taxable income, obtained by dividing the total tax liability by the total tax base. The marginal tax rate measures the additional tax burden incurred on an incremental additional unit of taxable income. Finally, the effective tax rate represents the actual rate including tax such as a taxpayer pays on its total net income. In contrast to the average tax rate, the effective tax rate is often calculated using accounting data from the profit and loss statement or the cash flow statement. To summarize, the tax base of income taxes comprises income from labor, or capital. The tax rate applied to the tax base can generally be either flat or progressive. Importantly, to gain a comprehensive understanding of your tax burden, you may consider statutory, average, marginal, and effective tax rates.